Hey, JJ here again with the Art of Value. This is episode 76, and today we're going to I'm going to respond to a video, an interview with Howard Marks, legendary value investor Howard Marks. I had a interview on Bloomberg, and also today I'm trying something different. I'm going to put the first 2 minutes of this on Twitter as a video, so if you're watching this on Twitter, click one of the links to go to your choice or to see the full video if you're interested in seeing the rest. And my Twitter is the Art of Value if anybody else wants to join me there. Okay, let's get straight into it.
I want to start with trying to understand investor psychology. And as a student of history, where are we right now in terms of bullish or bearish?
I think that attitudes were quite bullish prior to a few months ago, with the exception of a brief respite during the pandemic. We've been in a bullish climate since the end of the global financial crisis in '09. Not wildly bullish, certainly not what I would call euphoria, but optimistic. And that has been crimped now. A lot of the big name stocks are all 50, 70, 80%. The whole market is off, probably 15% from the high. So I would say that attitudes are more balanced today. When there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. So we're happier today than we were 6 months ago. I don't know if we're going to be happier 6 months from now. That is to say that the bargains will be more pronounced. But at least, as they say, the bloom is off the rose.
So he's saying that there's, as a value investor, there are more bargains around, more margin of safety, I guess. So he's happier now than he was during more elevated market. He didn't say it got too elevated, but obviously the innovation type stocks are down 60, 70, 80%, even more. So it's good hunting ground for value investors in this environment. Okay, the next question is about how do you position going at the moment. Financial media is always keen about how do you position here and there rather than being more long term. But talking about what he says in the next 6 months.
At a time of such incredible uncertainty, how do you position seeing value now, but also preparing for seeing more value in 6 months?
One of the 6 tenets of Oaktree's investment philosophy, which we established when we started in April of '95, and I've never changed a word, and I believe in thoroughly, is that we're not market timers. And that means mostly 2 things. We never sell to raise cash to prepare for a decline. And we never say it's cheap today, but it'll be cheaper in 6 months, so we'll wait. If it's cheap today, we buy it. If it's cheaper in 6 months more, we buy more. And I think that works much better than an assertion that we know where the market will be in 6 months.
Okay, so that's interesting. Again, that's something that Buffett has said as well, I think, where if some don't like catching a falling knife, especially momentum traders, but value investors, long-term investors, if it's cheap, it's cheap based on intrinsic value of the company, why not buy? And if it goes down in six months, if it keeps going down, keep buying. So you're kind of averaging down. But if it's cheap, it's cheap. And you can't predict the market. So he doesn't mind so-called catching a falling knife. And the next one is going to be about prospective returns in terms of price deterioration. Let's have a look.
Everybody gets concerned when prices decline. But if you flip that over, the flip side of price deterioration is increases in prospective returns. So now the prospective returns on many asset classes are higher than they were just a little while ago. And again, a much better climate for the bargain hunter.
Some people would counter this by saying inflation takes a lot of the value out of.
Okay, so that's interesting too, saying that the better forward returns should be where prices are cheaper. You talk about asset classes, but talk about stocks as well. If in terms of price multiples, so I know that Berkshire bought Apple when it was like 11 or 12 PE, for instance, and now, or recently, I haven't looked recently, but like to around 34, 35. So obviously, you get multiple expansion. If you buy cheap, and what you think is cheap, and you get multiple expansion as well as the company growing, you get both, and the share price should go up. So that's what kind of he's talking about there, but he referred to asset classes. So it could be a whole asset class really like that that's kind of undervalued. Okay, let's see if we can find the next one. It is around here. Let's try.
An increase in real returns.
How much are you trying to game out where inflation is going to go over the next 6 to 12 months, considering the fact that I know that you do not time the market or look at a sort of day-to-day price swing kind of issue, but this really does determine how important some of these returns will be going forward?
Yes, it does, but I don't think there's anything to be known on that subject, and I'm sure we don't know it. You know, and another tenet of our investment philosophy, there are only 6, we're going to touch on 2 today, is that our investment decisions are not based on macro forecasts. Macro forecasts are very important. The only problem is they're rarely right. And more importantly, any one forecaster is rarely right more often than the others. So we don't make our decisions on that basis. We are what's called bottom-up investors. We invest on the basis of micro, not macro, companies, industries, securities, and we feel there, through hard work and skill, we can get an edge.
So where...
Okay, so that's important too, saying we don't invest based on macro, so he might know a lot about market cycles. He's written a book about market cycles, which is worth reading, and another book about the most important thing, and of course there's many most important things that he talks about, but in terms of inflation and the macro forecast, saying that forecasting, you know, somebody might be right one time and wrong another time, and we don't try and do it. And Buffett also says that where they're basing it on fundamentals at the micro level of each company and not worrying too much about the macro environment. And sometimes the macro environment will drive prices down, but it's still based on the fundamentals of the company. All right, so the next one, we're getting close to the end. Where do you see, the question is about where they're seeing deep value at the moment. Let me see if I can find the right place for that, about here.
You know, they are much more spread around than they were before. You know, some growth names are offering much better value than they did a year or 2 ago, down 70%. But, you know, we continue to find opportunities throughout the investment universe, you know, the prosaic industries are also offering good value.
When you talk about...
So he's talking about, yeah, interesting that growth companies are cheap. Some of those ones, some emerging tech, for instance, down 60, 70, 80 or more %. So are they, this is why it's kind of silly to talk about growth and value, growth companies and value companies, value stocks, growth stocks, because as Buffett says again, growth and value are joined at the hip. I mean, if growth companies drop 60% or 60 or 70 or 80%, do they become value? Do they become value stocks? It just doesn't make any sense. So he's seeing sort of bargains in a number of industries, including prosaic. So even in the kind of more boring, unimaginative, not innovative, he's seeing value there as well. Okay, so let's see, investing in elsewhere outside the US. There's a question on that, which is interesting to listen to as well. Let's have a look.
Are also offering good value.
When you talk about the global investment picture, I know over the years, especially as the U.S. yielded less and less and yet less in real terms and in nominal terms, you looked overseas, in particular to China,
yes,
as a potential area of prospective return. Has that changed as yields have gone up in the U.S. and frankly the economy has slowed so substantially in China?
Well, on the one hand, we have a preference for investing in the U.S. You know, the U.S., in most regards, has the best economy in the world, and it has an excellent environment for rule of law, for being able to predict the outcome when various stakeholders' rights come into conflict. That's very important to us, especially you mentioned our business in distressed debt investing. That's very important if you're going to buy distressed credits, to be able to predict how we'll be treated by the law. from time to time, other parts of the world offer better bargains. We have the best in the U.S., but the best usually doesn't come cheap. So, and on the third hand, we like to have some diversity in our portfolio. So, we've been investing in places like China and India, in the last couple of years, and absolutely will continue to do so. When I hear people say, I've made my living for the last 50 years investing in the things other people said were uninvestable, high yield bonds, distressed debt, emerging markets in '98, et cetera. And when I hear people say that China's uninvestable, to me, uninvestable says maybe there are some bargains there if everybody else is boycotting that sector.
Yeah, that's interesting. Saying, everybody's concerned about investing in China and saying it's uninvestable. That's when he gets interested. Heard him say that before in a recent interview. Pricks up his ears when he says something's uninvestable, which means there could be something to it, especially not necessarily greater risk, but definitely uncertainty. So, he mentioned China and India there that they've been investing in. So one more. Let's see. I'm going to go right to around 10:40 in the video. And because he has something interesting to say that, again, a lot of these things are very similar to Buffett.
The point is, an area like private lending, where we're very active, has been a darling in the past decade. A lot of money and a lot of managers and a lot of funds have moved into the area. Buffett always puts it best. When the tide goes out, we find out who was swimming without a bathing suit. When economic and financial conditions become more difficult, we find out who made good credit decisions and who made bad ones. We'll see.
What's
interesting? So, the tide's going out, and let's see, swimming naked, as Buffett put it, not without a bathing costume. Talking about who's made bad decisions, this gets revealed when the tide goes out. When economic times change, it's fine when there's a bull market and there's a lot of money around, loose money, loose credit. But when the tide goes out, we see, and we've seen that with some of those funds that invested that bought really high, ones that say that valuation doesn't really matter too much, price doesn't matter. But we've seen, if you're down 90%, maybe you could have got that a little bit cheaper, or maybe it was a bad decision in the first place. I don't know. Especially, there's a lot of margin. There's been a lot of margin lending, a lot of options trading by retail investors, and that's kind of subsided. Okay, one more. Let's see where we are. Let's see. Here we go.
Become more difficult. We find out who made good credit decisions and who made bad ones. We'll see.
What's the historical precedent for this moment?
For this moment?
Okay, so this is talking about today's situation. He's had a lot of experience, more 50 years or more, saying if this macro environment is similar to anything else that he's been through before.
Oh, it's very hard to find one that fits exactly. We've never had this externality of the pandemic. There hasn't been a war going on in a long time, an important international conflict with the threats this embodies. The U.S. never had an economic rival like China before. We never really had an economic rival since World War II. And of course, we have historically low interest rates. We had interest rates went down by what we call 2,000 basis points. That is to say 20 percentage points from 82 to 22. And that was a big tailwind. So these conditions are not reminiscent of any that I've lived through. But I think the important thing for your purposes and hopefully your audience's purposes is that I think that our taken as a whole, I think conditions are fairly normal today in terms of how you should manage your money and the risks you should take. And to me, that's the key decision.
All right. So that's interesting, saying that it's not the conditions aren't really reminiscent of anything he's been through before, and but kind of normal in terms of carrying on investing. And he kind of says that they're fully invested. They try to be fully invested, but he's not seeing it as anything to be kind of freaked out about. Not that extraordinary, even though it's not. Especially interest rates been going down since the early 80s and to basically to zero, and now they're going up again. All right, so that's it for that one. I hope you enjoyed that. If you did, if you want to get more of the content next time, be notified subscribe on YouTube or on Spotify video. Those are the two video platforms. Just subscribe and follow where you can, and join me on the Art of Value, and for audio on other platforms like Apple and Google, etc., wherever you get your podcasts. Okay, see you next